More than 1 in 4 Australians have no idea what insurance they're paying for inside their super. Not what it covers, not how much it's worth, not what the terms are. They just assume it's there if they need it. But here's the problem with that assumption. Default super insurance isn't designed around your life at 58 or 62. It's a group policy designed to be cheap for the fund. And cheap policies come with catches. The most common catch is this: your $400,000 of life cover isn't actually $400,000. By the time you turn 65, that same cover may have dropped to $40,000. Same premium, same policy. 1/10 of the payout. That's not a typo. And it's not rare. It's how most default super insurance is structured, a system called unitised cover. And almost nobody tells you until you've already paid years of premiums for protection that quietly disappeared. What I'm going to walk you through today is the exact mechanism behind that drop, a simple break-even test you can run in about 5 minutes, and how to know whether you should keep your cover or cut it. If you're over 55 and you haven't looked at the insurance section of your super statement, you're likely one of those 1 in 4. Subscribe. I'll show you exactly what to check and what it actually means for your retirement savings. Most default super insurance uses a structure called unitised cover. Your cover isn't a fixed dollar amount, it's bought in units, and each unit's value drops as you age. A common example: $400,000 of cover at age 40 can fall to $40,000 by age 65, even though your premium stays the same. That's a 90% reduction in what your family would actually receive. And most people have never been told this is how it works. So why does it happen this way? The super fund buys group insurance on behalf of all its members because there are no individual health checks, no underwriting, and no questions about your lifestyle. The insurer accepts everyone, young and old. The trade-off is that the fund has to keep premiums low enough for a 25-year-old to stay in the system. The way they do that is by quietly reducing the cover amount as you get older, while the premium stays flat. You keep paying. Your cover quietly shrinks. By the time you're in your late 50s or early 60s, you could be paying $40 or $50 a month for a life cover payout that is a fraction of what's on the label. Now, there's a second trap layered on top of this. The default TPD definition in most Australian super funds is any occupation. To make a successful TPD claim, you don't just need to prove you can't do your own job. You need to prove you can't do any job at all. That is a very high bar. Choice magazine confirms this is one of the most common claim denial reasons in default super insurance. And then there's the average payout comparison. Research from Australian financial planners puts the average default super life insurance payout at around $142,000. For advisor-arranged policies, the average is around $547,000. That's not a minor difference. It's nearly 4 times more cover. And the gap comes almost entirely from the unitised structure and the any occupation TPD definition. Here's a simple illustration to show what that looks like in real numbers. Take a hypothetical member aged 55. They have default life cover of $100,000, paying a $30 a month premium. Over 10 years to age 65, they've paid $3,600 in total premiums out of their super balance. At age 65, their unitised cover has dropped to $40,000. If they've had any pre-existing health issues along the way, even that $40,000 might be at risk of denial. This is your retirement savings being used to buy insurance that is quietly worth less every single year. Maybe you're thinking, I'm 58, no dependents, house is paid off. Why would I even need life insurance? That's exactly the right question, and the answer might actually surprise you. Because the decision isn't as simple as cancelling it and moving on. There are real risks in doing that too. Let's look at how to work out which side of this you're on. Instead of thinking about whether you have enough cover, I want you to think about a different question. Is the cover worth what you're paying for it, given where you are in life right now? That sounds simple, but most people never do this calculation. They either assume the insurance is necessary and leave it alone, or they cancel it impulsively without checking the risks. Neither one is the right approach. I used to think everyone should have maximum cover inside their super. Then I ran the numbers for a 60-year-old client with no dependents and a house that was fully paid off. The default insurance was costing him $80 a month, $960 a year, that could instead have been compounding inside his super. Over 10 years, that's nearly $13,000 in lost growth at average super fund returns. And his cover had already dropped to $35,000 by that point. That moment changed my thinking on this completely. So here is the framework. It's called the break-even test. The question is, will the total premiums I pay over the next 10 years be worth less than the realistic payout I'd actually receive? Let me show you how it works with a real example. Greg is 58, no dependents, house paid off, and has $280,000 in super. His default life cover is $80,000 at age 58. Because it's unitized, by age 65, that cover will have dropped to $25,000. His monthly premium is $45. Over 7 years to age 65, Greg pays $3,780 in total premiums. His realistic payout if he claims, after the unitized drop, is $25,000. If we subtract the premiums he's paid, the net benefit to his estate is $21,220. Now let's look at the alternative. If Greg cancels the insurance and redirects that $45 a month into his super's default investment option at a 7% annual return, those premium savings grow to around $4,600 after 7 years, inside super, with the tax benefit included. That's the break-even point. Greg's default cover only makes financial sense if the payout he could realistically receive is worth more than the $4,600 in compounding savings he's giving up. For Greg, it isn't. His payout at age 65 is $25,000, but the net benefit after premiums is just $21,220. And that's only if there are no pre-existing condition exclusions to worry about. For most people in Greg's position, no dependents, no mortgage, enough savings to cover a short-term emergency, cancelling life cover inside super, and keeping those funds working for retirement is almost always the better financial decision. But the same logic applies differently if your situation is different. If you have a partner who depends on your income, or if you still have a mortgage or significant debts, then the cover calculation changes. The payout matters because someone else needs it. In that case, keep the life cover, at least until those obligations are resolved. TPD is a separate calculation. If you're still working, TPD cover has real value because a permanent disability at 58 or 60 could mean a decade without income. If you're already planning to finish work in the next few years and you have enough in super to bridge the gap, the value of TPD drops considerably. There's also one more hidden risk that makes default insurance worse for near retirees than most people realize. It's not just the cover that shrinks. The terms themselves can change without you being told. That's what we're going to look at next. Every dollar that leaves your super balance as an insurance premium is a dollar that stops compounding for retirement. That's not a dramatic statement, it's just how it works. And when you're in your late 50s or early 60s, compounding time matters more, not less. Let's look at what the two paths actually look like over the next decade. The first path is staying with default cover and doing nothing. The premiums keep coming out. Your cover keeps dropping. By the time you're in your late 60s, if something serious happens, the payout is a fraction of what you thought it was. And if the insurer finds a pre-existing condition in your records, it may not pay out at all. Your super balance is lower by the full amount of every premium, plus the growth that money never generated. The second path is reviewing your cover now. If you don't have dependents or a mortgage, cancelling life cover and redirecting those premiums into your super's investment option builds a larger pool for retirement. You're not relying on an insurance payout, you're building a balance that you actually control. If you want protection against smaller financial shocks, a straightforward cash buffer of $20,000 to $30,000 achieves most of what basic insurance would, without the ongoing premium cost. If you're still working and you do need TPD cover, the decision looks different. Keep the TPD component. The income replacement value of TPD is real if you're a decade or more from your target retirement age. But life cover, for someone with no dependents and no debt, often serves nobody in your actual situation. The goal here isn't to be insured for every possible scenario. The goal is to have enough money in retirement that the small risks are manageable without a payout. That's what financial resilience actually means at this stage of life. But there's a catch in this calculation that catches a lot of people out. If you have a pre-existing health condition and you cancel your default cover, getting replacement cover later can become very difficult or very expensive. That's the scenario we need to look at before you make any decision. Let's walk through exactly how that plays out. Here's where this gets complicated, and it's why I'm spending time on it before telling you what to do. Say you've had a bad back for years. Nothing serious, but you've seen a physio a few times. Your default super insurance has a 12-month pre-existing condition exclusion. You decide to cancel the default cover and apply for a retail policy outside of super. The retail insurer asks about your medical history. They see the back treatment. They either decline your application or add a permanent exclusion for spinal conditions. Now you're in a worse position than when you started. No cover at all for the thing most likely to stop you working. The second scenario looks different, but ends in a similar place. You keep your default cover. You keep paying the premiums for 5 years. Then you can't work anymore because of that same back problem. You put in a claim. The insurer reviews your medical records and finds you had treatment for a back issue before the current policy period began. The claim is denied. Choice magazine explicitly warns about this. Some funds do have pre-existing condition exclusions or waiting periods in their policies, which means your claim may be denied if you make a claim because of that condition. So you've paid 5 years of premiums for a policy that was never going to pay out for your most likely health event. That's money that will never be recovered. Now, here's the move that actually protects you in both scenarios. Before you cancel your default super insurance, apply for a retail policy first. Go through the underwriting process and see what you get. If the retail insurer accepts you with no exclusions for your pre-existing conditions, you have genuine cover. Cancel the default policy. You're better off. If the retail insurer adds exclusions or declines your application, you now know something important. Your default super cover, imperfect as it is actually the best cover you can get. You keep it. It's not ideal, but it's better than nothing. The key is to never cancel first and ask questions later. Keep the default in place while you shop. Once you have a confirmed alternative, then you make the switch. You've now run through the two big traps, the unitized drop and the pre-existing condition problem. The next step is the practical check. How do you actually look at what you have right now? I know logging into your Superfund's member portal isn't exactly how you want to spend a Tuesday afternoon. But missing this check could cost you $50,000 or more in retirement savings. It takes about 5 minutes. Here's exactly what to look for. Step 1. Log into your Superfund's online portal and find the Insurance or Cover tab. You're looking for 3 specific things. What types of cover you have, whether that's life insurance, TPD, or income protection. The current dollar amount of each type, and the monthly premium that's coming out of your balance for each one. If you can't find this online, call your fund. They are required to tell you. Step 2. Check whether your cover is unitised or fixed. Look for something called a benefit schedule or a cover by age table inside the documentation. If the cover amount changes every year as you get older, it's unitised, and you now know it's worth less than the label says. If it's a fixed dollar amount regardless of age, it's called stepped cover. That's a better structure, but it can still have other limitations. Step 3. Read the pre-existing condition rules. The place to find these is in the product disclosure statement, which your fund is required to provide. Search the document for the word exclusion or pre-existing. The exclusion period is typically 12 to 24 months from when the cover started. This tells you what conditions may not be covered even if your premiums are current. Step 4. Check the TPD definition. Find the relevant section and read it carefully. If it says any occupation, you face a high bar to make a successful claim. If it says own occupation, or any occupation you're suited to by your training and experience, the standard is somewhat lower. The difference matters significantly for anyone who works in a specialized role. Pause here for a moment if you're able to. Before you keep reading, open your Superfund's website and write down those 3 numbers from step 1. It takes 2 minutes. Once you have them, the rest of this makes much more sense. Step 5. Make the decision using the break-even framework from Section 3. If you have dependents or a mortgage, keep the minimum life cover. If you have no dependents and the house is paid off, cancelling life cover is likely the right financial call. If you have a pre-existing health condition, keep your default cover in place and apply for a retail policy first. Only cancel the default once you have a confirmed retail policy with no gaps. And one last thing to watch for. Super funds are allowed to re-add insurance to your account in certain circumstances, such as if you consolidate other accounts. If you cancel your insurance, check your statement every year to make sure it hasn't quietly been re-added. This is rare, but it does happen. You've now done the work that most Australians never get around to. There's one more piece to pull it together. To pull this together, default super insurance is cheap for a reason. The cover drops as you age, the definitions are narrow, and the terms can change without you being told. But the answer isn't always to switch to a retail policy. Sometimes the answer is to cancel the cover entirely. Sometimes it's to keep it. The right move depends entirely on your own situation, your dependents, your debts, your health history, and how close you are to retirement. What the break-even test does is cut through all the vague advice and give you a concrete number to work with. Total premiums over 10 years. Realistic payout at the end. Which one is bigger? That's the whole framework. You don't need to be an insurance expert to get this right. You just need to look at your super statement once a year and ask one question. Is this cover actually protecting anything that matters to me right now? Not 10 years ago, not in theory. Right now. If the answer is yes, keep it. If the answer is no, run the break-even test and decide with real numbers. If there's a pre-existing condition in the picture, do the retail policy check first before you cancel anything. That's it. That's the whole system. If you've never looked at the insurance section of your super statement and you're over 55, you're likely one of the 1 in 4 who's been paying for cover without really knowing what they have. Hit subscribe. I make videos for Australians who want to understand how their retirement money actually works. No jargon, no sales pitch, just the mechanics behind the decisions. Thanks for watching. You've got this.